Hello, everyone, and welcome to another VIP webinar. Today, we are going to be having a very important topic, and this is basically risk management one-on-one. And as we all know, this is very critical in trading. And if you think about it critically, whenever you begin trading, whenever you go for that deposit, you deposit money in your live trading account, you have quite a number of goals. And the number one goal on that priority is not to lose that money. So while you want to make profits, you want to avoid losses, the number one goal is not to lose the money you deposited in the first place. And that's why it's very important for you to master your risk management. So today we are going to be talking about risk management. We'll go through a number of subtopics ranging from position sizing, that is how you determine how much money to risk in a particular trade versus not just deciding to take in a trade without thinking about how much you are risking. So we also be looking at using a risk management calculator. It's very important to calculate how much money that you are risking in a trade. So once you understand that, then you'll know how to use the risk management calculator. Then number three is determining your risk tolerance level. There's always those scenarios where you decide to take a position in the financial markets, and then somehow it's, let's say, something that is more than you can bite, and then it kind of makes you restless. You are waking up in the middle of the night, check on your trades. In the morning, you're trying to have your breakfast. At the same time, you're checking on the markets. You're also monitoring every tick of the market on the one-minute chart. So some of these can be indicators of whether you're trading above or below your risk tolerance level. So lastly, we'll also be looking at the psychology of risk management. So we'll try to understand what goes on in your brain when you're doing your risk management and how to handle that. So hopefully, by the end of this session, you will be able to master your position sizing, you're using a risk management calculator, determining your risk tolerance level, and of course, mastering your psychology while doing your risk management. So before I make any progress, I would like to do a mic test, trying to understand if you guys can be able to hear me clearly. So if you can hear me clearly, can you type hi on the live chat section or even in the Q&A section, and these will help communicate back that I'm able to transmit my messages clearly to you. Awesome, I can see a thumbs up already. Hopefully, this is communicating that everything is working just fine. So thank you, Bernard, for joining the session. Thank you, Kezia and Samira. I really appreciate you. So let's get things going forward. So the number one thing when we talk about position sizing is trying to determine how much money should I risk in a trade. And this is quite common, a problem for majority of beginner traders, as well as intermediate traders. But then pro-level traders have already mastered these, and they usually or often don't have a problem with this. So let's say you do a deposit. Let's say you deposit $1,000 in your trading account, and now you are trying to determine how do I size my positions. Let's say you have seen a really interesting position in your trading, and you want to take this position, but you don't know how much lot size to take. So let's take it step by step and try to understand the entire process. I'll be using a very simple asset. So let's say we use the most commonly traded asset, which is the Euro USD. So Euro USD has been on this path. So we use a higher time frame to indicate what has been happening. So from around August last year, Euro USD has been gaining against the dollar, pulled back somewhere. This was around February, continued going up in March and April, pulled back on the month of May. Then in June and July kept going up. Then August, September has been going down, tried to recover in this month of October. But what we are seeing is the market consistently attempting to go up, but eventually fading and pulling back downwards. So Euro USD has been trading in this channel for quite a period. This is right from the 17th of July. So clearly the euro continuously losing against the dollar. So when you go to this area, the market slightly broke to the upper side, pull back downwards, didn't quite get to the bottom here. So I can remove this arrow and this arrow, and then broke towards the upper side, rallied all the way to this resistance, which was acting as a previous support at this point, and then pulled back downwards. So from what we are seeing is the euro attempting to continue with this bearish momentum, and it's very clear from the forward chart that the euro is continuously going downwards. So after doing your analysis, maybe use some indicators. Let's say they show you that the euro is continuously going downwards. So today, assuming that you are trading at this exact moment, you have seen that the market went up during the Sydney session, then during the London session, kept going down, and then at the beginning of the New York session, went up, found resistance, and then pulled back downwards. So let's say you are going for a continuation trade, and a continuation trade is based on the fact that we have this pin back or shooting star formation, where the market was attempting to go up, failed, and is now continuing the directional movement of bearish or downwards movement, and you want to capitalize on the downwards momentum. So clearly, you know that the market is about to break the today's low, as well as the low that we saw on the 23rd, that is earlier this week. And you want to continue trading as the euro continues losing to the dollar. So judging from what we are seeing in the dollar index, we have seen a very strong momentum happening yesterday, a slight pullback, and the market has continued pulling higher today, and now it's on the verge of breaking this resistance. So the dollar index breaking this resistance, it basically means that the dollar is very strong against a basket of commodities, a basket of other peer currencies such as the euro, the pound, the yen, the Canadian dollar, and so on. So in this case, you decide to go for this bearish trade, betting that the euro will continue losing to the dollar. So when you think about this, you want to know where is the euro headed next, and if I'm wrong, what could nullify my original objective. So if your analysis indicates that this previous high or at the top of this pin bar is your point of area where you decide you are wrong in the markets, then it becomes your stop loss. So if the price of the euro USD moves up to this area, then you decide that this is my nullification point and I want to get out of this market. So this is potentially where you set your stop loss. On the other hand, if it goes down and breaks this previous support, there is quite a number of lows that are prevalent. Let's say you think of this area. It was acting as support here, and then support here, and then support here, and now it's your target exit point. So in this case, if you are right, and the Euro USD keeps going down, you are betting that the market will continue going down and get to this point. So now you have set your entry point, your stop loss, and your take profit area. So in this case, if you use this crosshair here, this tool is called a crosshair. You can use it to measure the number of points between your entry point, stop loss, and take profit. So you can click, hold, and drag towards the upper side and measure the number of points. So this 249, roughly 250 points. So if you're wrong, you'll be losing 250 points. And if you're right, you'll be making 404 points. So what this basically means is that if you're trading a full lot, you will be losing about $250. And if you're right, then you'll be making about 420, this is $400. So if you're wrong, you lose $250. And if you're right, you make $400. So the very first thought that comes to your mind is that, is this position really something that I'm willing to take? Is it worth my account risking this money for this kind of return? So this brings up a very important idea, and the idea is called the minimum risk reward. So whenever you're taking a risk in the markets, you want to justify that the opportunity was worth the amount that you are risking in. And this applies in all other sectors in business. So let's say you're just a normal trader. Let's say you import laptops in Kenya and then sell in the retail sector. So if let's say you normally import laptops worth, let's say in terms of Kenya shillings, worth, let's say around $700. So that would equate to about 80,000 according to the exchange rate, and this could vary. So you import a laptop that is worth 80,000 shillings, and then when you sell it in the local market, let's say you sell this laptop for 100,000 shillings. So that makes you about 20,000 shillings for every laptop that you import. So that margin can vary depending on market conditions. So if let's say you import that laptop for 80,000 and you realize that when you sell it in the local market, the available demand is offering, let's say 81,000, would you continue doing that trade? Would you go through all the hell of importing a laptop for 80,000 and then only sell it for 81,000? Would that profit make sense for you? So all business persons have this minimum rate of return, which in Forex we identify as the risk reward ratio, that the below which they will not do any business and above which they are open to doing business. So let's say your minimum risk reward or risk return is let's say 20,000. So if you import every laptop in Kenya and no matter how much price you pay for it abroad, when you sell it in Kenya, you're looking to make a profit of 20,000 on every laptop. So if the profit is less than 20,000, you don't import. So this is the same logic that we apply in trading when we talk about minimum risk reward ratio. So if you are going to risk, let's say, an amount of money in this trade, let's say that amount of money is $100 in this trade, the return from this trade might be compared with what we are seeing here. So the way to do this is by simply doing a very simple calculation. And this is dividing the number of points in profit versus the number of points in the loss. So in this case, if you're wrong and you're risking $250 versus if you're right and you're looking to make $400, what is the ratio here? So in this case, I will be doing a very simple calculation on my calculator. I take 400 and then I divide by 250. So clearly, this is less than 2. This is 1.6. So what this means is that if you are risking $100, you will be making $160. So is that something that is worth your risk? So that's the question that you need to ask yourself whenever you're going for a position in the markets. So some traders will be comfortable taking positions that have a risk reward ratio of 1:5, 1:6, 1:1, 1:2, 1:3, and so on. So you need to identify that by yourself, what makes sense for you. So I know a lot of normal traders who will not go to China to buy electronics and then come here in Kenya and then sell at less than 100% from that position. So if you go to China and buy a consignment of goods worth 1 million, when you come to Kenya, you're looking to sell that for 2 million. If it's less than that, you'll not be buying those products from China. So the same thing applies to trading. So if you are risking, let's say $100 in a trade, there are traders who have a minimum risk reward ratio of 1:2, meaning that if they're not selling at 1:2, they will not be taking that trade. So personally, and this is not something that I recommend to you, you have to decide on your own. I prefer thinking of trades as 1:3 ratio. So I want to find a position where if I enter, I make 3 times the amount I'm risking in that trade. Sorry for that. So this can happen a lot in the markets. For instance, I remember during the market snapshot series. So this is a series that I normally do on weekdays from Monday to Friday at 11 a.m. on the FX Pesa YouTube channel, trying to understand what's currently happening in the markets, what news are we expecting for the day. And we go through all that every day and identify the potential trading opportunities. So this week, or early in this week, we covered a very interesting opportunity, and this was in Euro JPY currency pair. So in Euro JPY, this is what we had seen. So on the 4-hour chart, there was a major resistance point here. and the price was approaching this area, and we were projecting there is a likelihood that the market may react the same way it did the last time it got to this level. So we are looking for potential short selling positions when the market got to this area. So from the 1 hour chart, this is how it looks like. So we are looking at the market that attempted to break this area and then even dropped quite sharply. So the potential target was on the lower trend line, which you can see here, which has been acting as support. Every time the market has gotten to this area, found support and went up. So in this case, from this area, we expected the price to drop to this area, and once it gets to the trend line, then it finds supports and goes up. So in this case, when the market got to this area, now it's a decision to make. So unfortunately, we are not able to monitor it in time. Remember, the webinars are scheduled. So the only time we identified that this was happening was after this move had happened from this area down to this area. So there were already two candlesticks indicating a very strong entry by sellers. And in this case, we know that sellers had entered this market, the market had rejected that resistance and is now headed downwards. So now it's a decision to make between risking a trade, setting a stop loss just above this area here, and a take profit just at the trend line here. So when you identify the two levels, the question is really simple. Am I comfortable risking this amount of money here? This is 536 points, and then going for a potential take profit of 1,086. And this sounds like 1:2. If you divide 1,086 by 36, you'll clearly get more than 1:2. So is that your minimum risk reward ratio? So if it doesn't qualify, then this is not the trade for you. But if it plays out, then this can be the trade for you. So what this means is that if you can risk $10, you would make $20. If you can risk $100, you can make $200, and so on. So if you can risk, let's say, $70, your potential profit would be $140. So you need to determine your minimum risk reward ratio, and this does not depend on anyone else. It depends on you and what you decide versus how much you backtest your strategy. So you need to know that if I'm using this strategy and I risk $10 and target to make $30, then that is something you can actually actualize. That's something you can actually realize in the markets. And once you backtest and determine that this can work, then you definitely go for that. So in this case, let's say you decided to risk an amount of money to short from here and target to make profit at this point, whereas your stop loss was here. So depending on your account size, you might have to use a different lot size. So if you have, let's say, $100 in your account, the lot size you would use, it's not the same as the person using $500 in their account, $1,000, $10,000, $20,000, $100,000, and so on. So for the purpose of this presentation, I will be using an example of a person who is trading with a $10,000 account. So let's say we use a real-time example, and I'll try to use something pretty simple. Let's say, okay, the oil price has really gone up. Doesn't seem quite realistic. So I want to use something that is very close to its support or resistance level. And then from there, we can make a judgment on what you might use going forward for a trade. So a very quick search here. Okay, here we have an example. This is the US dollar trading against the Canadian dollar. So from what I can see in this chart, it's a market that is currently retesting a major resistance area. Okay, I can clear all this just to make it clearer for everyone. So I basically like clean charts. So this is our resistance level. So the idea behind this is that the market was going up at some point, and once it got to this level, sellers came in and pushed the prices back downwards. So the market was unable to break this level. And now, for a second time, the price has come back to the same level. It has really attempted to break this area here. And then from the candlestick that was attempting to break this area, it closed basically lower. And now the market is attempting to break this level for fourth candlestick, and somehow it has not broken yet. So this is not a signal to enter, but I will use it for a very simple explanation to try and understand the concept of risk reward. So let's say at this point, you identify that a week ago, this was the highest price that we saw on that week. So price found resistance here, went down, found resistance again here, and now it might be the target area if the price was to come back downwards. So in this case, the idea is that if the market is unable to move higher, it would drop back down to this area here. But then if it's very strong and keeps going up, then it could rise above this area. So if price rises above this area, then our initial idea is nullified, meaning that we don't have confidence that the market will go up. So in this case, from this area going up, if you were to set a stop loss, it would be worth around 282 points. On the other hand, we are here, this is 490 points. It's slightly less than 1:2. So this is 490. So 282 points versus 490. If you do your math, the double should be 560. So in this case, it basically means that the risk reward is less than 1:2. So let's assume that your risk reward is 1:5. So the trade qualifies as an investment opportunity. So you decide that I'm going to take a position here. So how do you go about it? So I'm going to use the demo account as a risk management tool that you use to test out your trades. So let's say from your demo account, you go for a new order. Remember, the demo account doesn't affect you financially in any way. So let's say your account has $10,000, as I mentioned. So with $10,000, you want to risk, let's say, 2%. So 2% of your $10,000 would be $2,000. So, sorry, not 2,000, but $200. So let's say you decide to use a lot size of 1. So if you sell by market, then you set your stop loss here. Notice the amount of money at risk. This is $222. And this is slightly higher than your 2% target. And if you set your take profit, in this case, it's what? Let me delete the line. I want to delete the line here so that you can see the order. So you can go to object list and then delete your horizontal lines. This is usually normal. Okay, let's delete them all. So these are profit target. So you're looking to make $547 and your risk is $222. So remember, when you're doing this, it's on your demo account. It's not on your real account. So $222 at risk and take profit is $547. So currently it seems viable, but on one side, the trade is way above your risk tolerance level, which is presumably $200. So how do you tackle this? So you keep on interpolating. So you just close a trade and then attempt another trade. But then in this case, we use a different lot size. So instead of using one full lot, how about if you use 0.98? So we still sell by market. Set our stop loss again. So now it's 132. So it's slightly lower. So if I adjust 151, and if I set my stop loss, my take profit right here is about $932. So you can do a take profit of 932, but original take profit was here, the previous high. So this is 410, an adjustment from over $500. So now you are targeting to make $410, but your stop loss is 151, which is basically 1.5% of your account. So does this make sense? If it does make sense for you, then you go ahead for the trade and execute this in your real account. So if it doesn't, then you go back to the drawing board, you go to a new order, and then you draft a different size. So let's say we do 0.99, sell by market, and then we set the stop loss again. So now we are risking 166 and take profit at 389. So you can keep adjusting this up until you find the right size that you can implement in your real trading account. So essentially, what I am doing right here, right now, is that instead of using a risk management calculator that you'd have to, let's say, install on your trading app, you'd have to, let's say, go to a third-party website, I'm showing you a very simple trick or tactic where you can use these in your trading. So rather than doing all that, just do a sample trade on your demo account, see how it plays out, how much you'd be risking on your stop loss versus how much you'd be risking on your take profit. And if you are now comfortable with that amount, then all you have to do is to now log in to your live trading account and then execute the same trade with that lot size that you have determined for yourself. So that will literally help you solve the position sizing issue. So once you resolve the position sizing issue, now you can move on to other issues in your risk management journey in trading. So now that we have resolved that, let's move on to the next part of the presentation. And as we progress, I would really like that if you have any questions relating to the presentation, you basically type that question in the comment section or the Q&A section, and I'll be responding to that as we approach the end of the presentation. So I know that you guys have a lot of questions, so just type that and I'll respond. So towards the end of the presentation, this is when I'll be looking to answer your questions. So we have covered the position sizing issue, and the issue of risk management calculator has been nullified because now you can use your demo account. So the next part is determining your risk tolerance level. So risk tolerance level is the amount of money that you can risk in your trading account, be it a dollar number or a percentage of your account that would impact your next trade. So we have been trading for a while, and know you guys have also been trading for a while, and you know that sometimes you just take a trade and you feel like, what was I thinking? Why did I take such a huge trade? Why did I risk such a huge percentage of my account? It makes you restless, and in case it goes badly, things get really worse in terms of your emotional status. So for instance, let's say you have a $10,000 account, and then you enter a trade risking $3,000. How much would that affect you if you just left your trading desk and then you went to the, let's say, nearest hotel for lunch? Would that affect how the lunch tastes or the taste of your lunch? Would you feel uncomfortable being at lunch and not being able to access your trading platform, not being in the knowledge of how the market is performing? So if that destabilizes you, you're at lunch and you still want to know where the market is, where it's headed, you have this strong urge to go back to your desk and check how your trades are performing, then there's a high likelihood that you've basically beaten more than you can handle. So you want to trade smaller trades that make sense for your account. So you want to take those small trades where even if you go for lunch, if they are in the evening and you go and sleep, you don't want to wake up in the middle of the night to check on the markets. Remember, you cannot change what the market will do. You can only change your own reaction to what the market does. So you want to be in a position where if you sleep and you have open positions, you have set your stop loss and take profit, you will be very much comfortable. So for instance, let's say your account size is $10,000. You have decided to risk just $200. So you have entered a position in, let's say, gold. So when you go to sleep, know that if I'm wrong in this trade, I'll have $9,800 in the morning. And if the risk reward is 1:3, then I'll wake up with $10,600 in my account. So in that case, when you go to sleep, you are completely in control. You know what might happen to your account. You have fully accepted the risk that you are taking in that trade. And in that case, the trading process becomes simple and your mental status becomes more stable. You are not disturbed because of the markets. So when you wake up early in the morning and go and check on your trading app, if the balance is 9,800, you might have this slight feeling of disappointment, but it will not have a large impact on how you continue trading for the rest of your day. On the other hand, if you have made some profit and you have 10,600, you'll be slightly happier, but it won't have this big impact on your emotional status that you go for even larger or bigger trades. So the idea here is to maintain the right level of discipline and, of course, target to execute quality trades rather than quantity trades. So for any beginner, the largest mistake they always do is doing quantity trades rather than quality trades. They have $10,000, they want to double that within a week or within a month. So in that case, they take huge trades looking to make a lot of money from the markets without really thinking about their risk management. They're not thinking about how much capital they want to retain. They are thinking about how much capital they want to make from the markets. And in that case, that can be detrimental to your account, and you want to rethink that as you go forward. So let's get to the next part of the presentation. And this is the psychology, and I think I've already jumped into it. So the very common mistakes I normally see with beginners is, one, they don't have a risk management plan. So every time you're trading, you should have these things set out in numbers and probably written somewhere. So first things first, you need to write down your risk tolerance level. So if I risk, let's say, $100 in my account, I will be completely unstable. I will not be thinking straight. That's my risk tolerance level. If that risk tolerance level is $500, $1,000, it really varies from person to person. It basically depends on your financial outlay. For instance, if you have an account with $10,000, and let's say a person like Uhuru Kenyatta, and he has an account with $10,000, your risk tolerance level will not be the same. For you, you might be willing to, let's say, extend your risk tolerance to, let's say, 5%, maybe risking $5,000 in that account. Sorry, not 5,000, but $500. But for Uhuru Kenyatta, he might be able to risk the entire account in one trade, mainly because your financial status is different from Uhuru Kenyatta's. So it's the same for every other trader. You need to realize your own financial tolerance level or risk tolerance level, how much you can risk, and that would not affect the next trade. So the next part that you need to think about is how much of that money do you need? So I know a lot of traders tend to trade money that they need. Some traders will put in the savings that they need to use by next year, January, to pay school fees for their kids or to buy a certain item and so on. So some traders will feel like this money is just sitting idle in my bank account. I don't need it right now, but maybe I need it in the next 3 months or 3 weeks or whatever that period is. So if you're risking that money in the trades, it tends to be a wrong decision because it puts so much pressure on you, especially on your psychology, when you think that I need to make some profit from this money so that I can put it back in my savings and use it, let's say, in 3 months to get this thing done. So the idea of trading basically means that you put money that you would not need in a long time. So this basically removes the expectations that you have in that account. So if you have expectations of using this money, let's say to pay school fees in January, to pay for this product or this service in January, then you'll have so much pressure to make that money or to make a profit out of that money within a short period of time. So that tends to strike some reactions in your brain where you might want to take some very quick positions to justify trading opportunities even when none exists. Literally, there are some times when I just open up my MT5, look for trades, and just decide the market is just moving awkwardly today. I don't see any opportunities. There's no reason for trading today, and I'm completely okay with that. So you need to understand that the markets will sometimes have opportunities, and some other times there will be no opportunities, and that's completely okay. So the market basically gives you what you have planned. If you have not planned, then it takes your money. So you have to really develop your plans. And when the market presents that opportunity, then you take that money from the markets. So I'm already seeing a question here. Can I calculate my risk tolerance loss based on margin call level? For instance, if I have $2,000 and I want to maintain a margin call level of plus 600%, no, I think this is from the broker side. Different brokers can have different margin call levels, and that does not interact or does not have a relationship with your risk tolerance level. So your risk tolerance level is very personal to you. I'll use a very simple example. Let's say there's a game between, let's say, Chelsea and Man United today, and then you decide to bet. Let's say you decide to bet $1,000 on that game. Let's say betting on a Chelsea win. So if you are right here, right now, listening to this presentation, would you feel the urge to delve from this screen of this presentation to go and check how the game is going? Would you feel the compulsion to go and check minute by minute how the game is progressing, who is scoring, who is not scoring, who has missed a penalty? Would you feel that compulsion? If you'd feel that compulsion, then it probably means that you're trading higher than your risk tolerance level. So it's an iteration technique that you have to keep playing to understand what your risk tolerance level is. So once you understand that, then you trade below it, because whenever you trade above it, then you trigger a lot of emotions that might involve greed, revenge. You might have this rage of, getting angry with the markets, getting sentimental with the markets, and so on. I've seen a couple of traders telling me, Rufas, I don't trade gold. That pair has never treated me well. They get sentimental. So even when I have some really good analysis about gold that presents a nice trading opportunity for them, they just don't take the opportunity because they got sentimental. And the baseline reason was because they were trading above their risk tolerance level. So it's very important you understand your risk tolerance level and then use it in your trading to determine whether this opportunity is good for me and then not take too much of a bite. So the other key thing that applies in risk tolerance level is basically the trading of news. So I've seen a lot of traders going for news because they can bring in some much needed volatility in the markets, and you see some really nice trading opportunity. But then for these traders, they basically just throw away their risk management rules, and they end up losing a lot of money during news announcements. So the main reason this happens is because they have not identified their risk tolerance level. So once you have identified your own risk tolerance level, you use that as a limit. So even if there's news, let's say your risk tolerance level in your $10,000 account is $200. Okay, let's push it even further. Let's say this is $500. So even if the worst of the worst happens in that day, and you lose a lot of money, the maximum you can lose is $500. So you'll still have $9,500 in your account. Then there comes a big news announcement. It could be US CPI, Consumer Price Index, could be the US non-farm payrolls or the NFP. And then there's been a big announcement. There's a big discrepancy between the expectation and the actual data. And you decide to go for a trade. So when you go for that trade, you've checked that trade on your demo account, set your stop loss and take profit, and you know absolutely well that if I'm wrong, I'm losing $500. And if I'm right, let's say I'm making, let's say 5 times that, 2,500. So if things go well for you, you make money, that's all, no case, no, nothing to think about. But then if you're on the wrong side, you lose $500. But then since you are trading within your risk tolerance level, you know that you approach this announcement professionally. And tomorrow when you wake up and start trading, you know, I made this decision, I made it consciously, I didn't go above my risk tolerance level, my account is still healthy enough to go for another trade. So by identifying your risk tolerance level, you basically protect your capital because you make sure you don't go above that risk tolerance level. So I want you guys to think about it this way. Whenever you're crossing a highway, a very busy highway, you normally think clearly, you look right, you look left, you confirm the right again, you also confirm the left again before crossing that highway. And then you do the same for the other side of the highway, and you always cross that safe. So when you do it so many times, you've been using this highway crossing every day, let's say going to work or whatever you are doing, you have always been very conscious about looking right, left before crossing. But then it comes to this point that you're so used to crossing this highway that you lower your guard. Think now you can wear some headphones, listen to some music as you're crossing the road. Sometimes you don't have to look right, you don't have to look left. And then eventually you get hit by a boda boda. So that's how it happens in the market. Every time you're entering a trade, you are taking a risk. There are cars crossing the road. There are factors impacting the markets either upwards or downwards, and sometimes you can get caught on the wrong side. So you're always trying to be safe. Even if you have a losing trade, you're not losing your entire account. You're only losing a small amount so that you can use other trades to recover that money. So when you lower your guard, and this is very common with traders, basically means that you start trading or messing with the risk tolerance level. So if your risk tolerance level is $500, now you start thinking, this is a real good position. I've been trading it for a while. I've been making money from it. This time I'm not going to use $500. I'm going for $5,000. This is my home run. This is where I'm getting the money I've been looking for. And this is the moment you make the worst mistake. After building the account for a couple of months, you find that one trade or a couple of trades basically ruin the progress you've made over a period of time. So always keep your guard up and never underestimate or cross that risk tolerance level. It is there to protect you. It's what keeps you sane. It's what keeps you thinking straight in the markets. I personally have been through the same, where I felt that I've been trading this pattern for a while. I've been making $100 in each trade, and every time I find this opportunity, and so far it has been playing out well. So why don't I risk $1,000 and make a home run out of this? And the moment I snap that decision and decide this is what I'm going for, I find myself reading my account. So try and identify that risk tolerance level for yourself, which varies from one person to another, and then make sure that you never go above it unless your financial position changes. So risk tolerance level is not permanent over time. So your fortunes may change over time. So when you start trading, your risk tolerance level might be $100. And then a couple of months down the line, it's 500. A couple of years down the line, it could go to 1,000, 2,000, 5,000, and so on. And in that case, you still maintain the same discipline. And that's how you become a pro level trader in terms of risk management and protecting your capital. So hopefully this session has been helpful to a lot of you traders. And if you take this personally, there's a high likelihood that you will not blow your account. So thank you very much, guys. Seeing there's no other question. So I appreciate you for joining the session, for taking the time to share some responses, and I hope to see you on the next session.